They always snipe setups like this, and after this video, you should be able to identify these type of setups, so let's get into it. No matter the strategy or approach you have, we should always start by understanding the market structure and price action. From the beginning of this market, the price starts from a high and drops down into a low. Now what's important is what comes after this low, because we see that what it comes next is some upside movement. However, the important part of this is that it ends below the last high. What this says is that buyers tried to push up the price, but it did not manage to break above the last high, and instead it ended below it. So, this new high, if it's lower than the last one, then that means that it's a lower high. A lower high is a swing point that is met on downtrends. And we also see that after this lower high, the price then pushed down and broke below the previous low. So if the last low broke to the downside, that means that now we got a new low, which is lower than the previous one. It's why we call it as a lower low swing point. Now until this point, the market has been following a downtrend. We know that from the swing points, because it's on downtrends where we have lower highs with lower lows, but now if we look at what happened next, is that we got another push to the upside. And what's special about this one is that it breaks above the previous high. That means that now we have the very first higher high we've seen on this price action. And when the market was previously following a downtrend, with highs that end constantly lower than the previous ones, but then the market forms the first higher high, well, the break of that first high indicates that this market is shifting its trend into an uptrend. It's why we call the first swing break as a market structure shift, or you might also see it as a trend change or change of character. They're the same concept, just under a different name. Now, if the trend should reverse into an uptrend, that means that we no longer want or expect a lower low. Basically, we don't expect the last low to break down, but what we now expect is for the upcoming low to not be able to break below the previous low, and so it should end as a higher low. A higher low is a swing point of an uptrend, and a higher low is followed with a higher high. This part is extremely important, because if this downside pullback should end above the last high, and then if it should be followed with an impulse to the upside that breaks above the last high, that means that we can follow with a buy-long setup from this low and exit with a take profit above the last high. But for the planning of the setup, we need to know where exactly this higher low will end. And here, it's where demand levels come into play, because higher lows usually will end on demand levels, and they are found on the last low before the market broke above the last high. And more specifically, it's the last downside candle before the upside impulse that caused the break. So that lower high should end somewhere inside this level, which means that we can plan the setup with a buy position on the top of the demand. We place it on the upper level of the demand so we don't miss the entry. Because if we would have the entry in the middle, for example, and if the market just touches the upper level and then bounces to the upside, in that case, the position doesn't get opened. So that's the logic behind placing the entry on the top of the demand. Now the stop loss is simply placed below the demand, with the logic being that if demand levels start breaking down, the market will probably enter into a downtrend. And of course, on a downtrend, we will have the market going lower and lower, and the last thing you want is having a wide stop loss on a downtrend, because that means that you take a bigger loss. It's why if this happens, and if we have the stop loss below the demand, we still lost the setup, but at least we lost as little as possible. And the take profit, since we are in an uptrend, on uptrends we have formations of higher highs, and if the market creates a higher high, that means that it must break above the last high. And that's exactly where we would look to place the take profit, so above the last high in an expectation of a new higher high. Price is pulling back down, eventually hits the demand. That means that the buy setup has opened. It bounced to the upside after hitting the demand, and this bounce keeps holding up, and it eventually closes the position on the take profit getting hit. So far it's nothing so complicated, but you need to master every part of it, because now we're getting into what makes a huge difference. And that thing is about using time frame alignment. The way we implement time frame alignment is that the moment the market hits the demand, we don't actually plan a setup from this demand, but what we do instead is that we switch into a lower time frame on the exact moment the price hits the demand. It can be any time frame as long as it is lower than the initial one. For example, now we're on the 4-hour chart, and this is the same price. Same market, but seen on the 15 minutes chart, right on the moment the market has hit the demand from the 4-hour time frame. We start here the same as we did on the higher time frame. Basically, we start by analyzing this price action structure. Same as the high time frame. Here we also start from a high, and from that high we see a downside movement that ends into a low. From this low, the market pulls back up and forms a high, Now this high, as we can see, it ended below the previous high. In other words, this new high was not able to break above the previous high. And so if it ended below the last high, that means that this is a lower high. A lower high, as I said and you've seen before, is a swing point that is met on downtrends. And the next swing point after a lower high should always be a lower low in case of a downtrend continuation. And a downtrend continuation means that the last low constantly breaks down into a new low that, as I said, must be lower than the previous one. And so that's how a lower low is being formed. Then we see that from this recent low, the price pulled back to the upside, it's looking to form a high, but should this high be higher than the previous one, or should it end lower than the previous one? Well, if we don't see any bullish signs yet, so basically a sign that this price action is reversing into an uptrend, then we just expect trend continuation. And if the market is following a downtrend, we keep a downtrend bias. So that means that the high should end below the last high so it can form a lower high, which is a swing point of a downtrend. And if the market can't break above the last high and it ends below, then after that, the most likely scenario is that we will have the next low breaking below the previous low. And so it should keep a downtrend swing point of a lower low. And we see that's exactly what had happened. The price basically pulled back to the upside and formed a high that ended below the last high. So it has formed a lower high, and from that lower high we get downside pressure into breaking below the last low, so it forms a lower low swing point. So far, it kept what it has already done. It kept this downtrend pattern. But now what had happened is that the price eventually went up and broke above the previous high, which was a lower high. And if the price now breaks above a lower high, that means that we now have a higher high, which is also the very first higher high on this low time frame. And if you remember from the higher time frame, when the market was previously following a downtrend and it had lower highs, but then we get the very first higher high because the market broke above the last high. That first upside break above the last high is a trend shift, from a downtrend into an uptrend. Now this is an internal shift, because this same price action happened on the high time frame as well. And when it happens inside of a low time frame, we just call it an internal shift. But it's essentially the same thing, nothing different. Now exactly as you've seen on the high time frame, the same theory and logic applies here as well, meaning that after the trend shift into an uptrend which created the first higher high, a pullback should happen, and this pullback should end above the last low, and so it needs to end as a higher low that is then continued with a higher high, since that's what happens on uptrends. So we need to know where this higher low will end, and we do that by identifying a demand level, since it's usually there where the price will often fall down into and then bounce to the upside. The demand is found on the previous low, before the price caused the trend shift itself. More specifically, it's the last downside candle before that upside push that caused the break above the last high. And this is an internal demand because we see that this demand is inside of the higher time frame demand. And now we can plan the setup. A buy position from the top of the internal demand. The trick when we apply the time frame alignment is that it allows for the stop loss to be placed below the internal demand from the low time frame, but with the take profit target from the high time frame. So if we switch back on the 4-hour time frame, we see how the market broke above the last high and turned the trend from a high time frame downtrend into a high time frame uptrend. A high time frame uptrend is formed with a higher high swing point, which we already have. That is then followed with a higher low, and that higher low should end on a demand. Demand that we already identified, and it's also where the price is sitting right now. Now because we've seen the internal trend on the low time frame reverse from a downtrend into an uptrend, we should now expect the price to bounce into breaking the last high from the high time frame. And so that's exactly where we look to place the take profit. It's how you can get these high risk reward setups, essentially by noticing the exact moment of the trend reversal from a low time frame. Now if you found this useful, I highly suggest you watch more of our content. On our free content, we focus on you actually starting to win. Then you could also take a look at our program where we now focus on not only winning, but mainly how to not lose the wins back. Because winning is not the hardest part. The hardest part is not losing the profits back.